As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation.
Powell is manipulating the markets again. The Fed has stabbed investors in the back. Is the pivot point approaching, after which markets have historically written off tens of percentages? GDP growth projections have been lowered. The inflation rate will not reach its 2% target until 2027, and unemployment is rising. At last week's meeting, the Federal Reserve held interest rates steady at 4.5%. The decision came after the Fed in January broke a streak of 3 consecutive rate cuts that began last September and brought the overall interest rate down from 5.5% to 4.5%. What other economic projections has the Fed announced, and what does that mean for your portfolios? We'll take a look at that now. Fed Chairman Jerome Powell told investors at Wednesday's press conference that the economy is growing at a steady pace and the labor market remains strong. As for inflation, Powell acknowledged that the level is still elevated, but there has been a noticeable easing over the past year. Core consumer prices, which exclude volatile components such as food and energy, slowed to 2.6% annual growth in January 2025, from 3.1% in January 2024. This decline suggests the Fed is moving closer to its 2% inflation target. Thus, ordinary Americans may experience slight discounts when purchasing certain items, but all days are not over. The reason for continued caution, according to Powell, is also the need to closely monitor the impact of recent policy changes, mainly tariffs, on inflation and economic growth. According to the central bank, tariffs will have an impact on inflation in the short term. In effect, he is telling us that inflation may rise slightly, but they are counting on it and are prepared to intervene nimbly if necessary. So the Fed is taking its time to assess the situation and remains in a wait-and-see mode. They are expected to proceed with further gradual rate cuts later this year. According to the current DOT charter, which the Fed uses to record individual bankers' projections of future interest rates, they are expected to fall below 4% this year. Then, in 2026, most Federal Reserve bankers are projecting a decline below 3.5%. In the years after that, the cuts should not be as rapid. The Fed also announced in April that it would further slow the pace of quantitative tightening. The monthly limit for buying U.S. Treasuries will be reduced from $25 billion to $5 billion. This is the Fed's method of keeping the economy in balance without exposing itself to unnecessary risk. But the Fed's summary of other economic projections has produced several other significant changes. The GDP growth forecast for 2025 was lowered from 2.1% to 1.7%. The expected core inflation rate was raised to 2.8% from the 2.5% originally forecast. This increase partly reflects the impact of recently introduced tariffs and subsequent retaliatory measures. The unemployment rate is forecast to increase slightly to 4.4% from 4.3% currently. What's also steadily increasing is the number of subscribers to our channel, so don't miss out on any news from the world of stock markets. So the Fed meeting confirmed an increased level of uncertainty about the economic outlook. If the Fed's median outlook for the next 3 years comes true, it will be the weakest 3-year period of economic growth since at least former President Barack Obama's first term in the White House, and the slow recovery from the 2007 to 2009 recession. Although growth forecasts have been more moderate, they continue to suggest continued economic expansion. Powell acknowledged during the press conference that the recent tariffs likely caused a significant portion of the elevated inflation forecast. However, he assured that the Fed would focus on distinguishing between tariff inflation and other factors that affect inflation. Thus, the Fed remains cautious and does not expect inflation to reach its 2% target until around 2026 or 2027. And how will stocks react to this? You can easily find out on 𝗕𝗂𝗋, a unique and sophisticated platform where you can find countless analyses, community insights, flash news, or fair prices of individual stocks based on DCF and relative valuation. This lets you know right away where your favorite stocks stand right now. Finally, let's take a look at an interesting statistic on how stock markets have performed during the Federal Reserve's rate cuts in the past, which can give us some clues as to what we should expect in the markets, and the central banks themselves are learning from this. The Fed's history of pivots shows how crucial a role the U.S. central bank plays in managing the economy. On several occasions in the past, the Fed has had to adapt to crisis situations. For example, during the Great Depression in the 1930s, when it initially raised interest rates, deepening the economic slump. It later corrected this by cutting rates and expanding its balance sheet, thus starting a gradual economic recovery. After World War II, the Fed kept rates low to stimulate the economy until it gained greater independence from the government in 1951. In the 1970s, the Fed faced stagflation, a combination of a stagnant economy and high inflation. Then Fed Chairman Paul Volcker dramatically raised interest rates, which, while leading to a recession, helped bring inflation under control. During the 2008 financial crisis, the Fed moved to cut rates to near zero levels in an unprecedented move and introduced quantitative easing, buying government bonds and mortgage-backed securities to boost the economy. This strategy has become the new standard in central bank crisis management. The COVID-19 pandemic in 2020 prompted the Fed to again resort to aggressive rate cuts and a return to quantitative easing. In addition, it has introduced a policy of average inflation targeting, which tolerates temporarily higher inflation in order to boost economic growth. Historical data shows that significant Fed rate cuts have often led to bear markets, with the average stock market decline following a significant rate cut reaching 27.25%. Now we find ourselves in a similar situation. The Fed began cutting interest rates last year, and will continue to do so even though the cuts are currently on hold. To make sure you don't miss any news or updates on just the interest rates and market reactions, subscribe and like, so you don't miss anything. What direction do you think the markets will take this year? Will the S&P 500 end in a loss or notch more gains? Let's discuss this in the comments or directly on 𝗕𝗂𝗶𝗀𝗋. Good luck with your investments.